Saturday, December 26, 2020, Monaco 64, home of alternative economics and contrarian views. So today I'm going to look at the crisis that we're in. It's a debt crisis, an economic collapse. And some of you have said, well, I talked to friends and family and they say it was caused by the current health crisis. Can you explain in the video why it wasn't? Well, that's what I'm going to do today. It is a debt crisis, basically. And it's been brewing for over 50 years. Yes, we've had other crises along the way, but I think this is the culmination of it because the system just can't keep going anymore. And I would say, of course, you can go back even further than 50 years. You can go back to 1914 when a lot of the big European powers went off the gold standard. But I'm going back to the early 70s, of course, and the close of the gold window. The Nixon shock, right, August 15th, 1971, basically was a default by the United States, but the system was able to keep going, and the debt has kept growing. And the other thing I would like to say, there's a difference between the national debt and the deficit. The deficit is the shortfall in government financing, for example. It's how much the government spends more than it taxes. It has to borrow that, and that's the deficit. And the deficit adds up over time as the national debt. And of course, it's not just the government, the federal government or the UK government that's borrowing. It's also corporations. It's also individuals. But I'm going to focus today on the government because this is a Keynesian problem as well. The Keynesians think that government borrowing and deficit spending is panacea to the business cycle. They don't think that the market can do the job. And they have a calculation called GDP, and I think it's important that we go through that before. So you can see here how government spending or deficit spending actually adds to GDP, and we're going to go through a lot of data today. But we need to go through this definition first. So GDP here, according to the expenditure approach, and it says here, according to the U.S. Bureau of Economic Analysis, which is responsible for calculating the national accounts in the United States, in general, the source data for expenditures components are considered more reliable than those for the income components. So this is what the U.S. government uses. So the equation for GDP is, so GDP is Y equals C plus I plus G plus X minus M. So what does that all mean? Well, C is consumption, I is investment, and the important thing here for us to see or notice is G is government spending, and of course net exports is exports minus imports. Government spending is important because we're going to look at how deficits actually kind of cover up economic weakness, and governments don't create wealth. I don't even think government spending should be in the GDP, but it is. And that's why the GDP looks better than it does, especially when there's a budget deficit. Let's say if there's a budget deficit of 5%, the economy is going to look a lot better. If GDP grows by 5%, you could actually argue that taking out the government spending, it would be flat, right? So that's the first thing I wanted to show you. The other one is an article that I talked about, let's see when it was, sometime in mid-November. Pandemic fuels global debt tsunami. Yes, that is true. The current crisis has increased the debt even more. It's gone exponential. They focus a lot on emerging markets, but at the end of this article, they say debts in advanced economies rose by more than 50 percentage points this year to hit 432% of GDP by the end of September. This is, of course, including government and all kinds of debt, corporate, individual debts, local government, all of it. But this is just to show you that it's gotten even worse. I'm going to look at the data really just going up to around 2018, 2019, just to show you that things weren't great, really, before the current crisis. And it was caused, long term, it was all the debt and deficit spending and government crowding out the private sector, of course. Short term, I would say it was actually triggered in September of 2019 by the repo crisis. I've done many videos about it, and I created yesterday a playlist, the repo crisis playlist. There's 14 videos in there. I don't expect you to watch all of them, but go through some of them. I explain exactly what was happening from September while the crisis was ongoing. I explain what the repo market is. I'm going to give you here a brief summary of what it is. It's basically a big pawn shop for Wall Street and the major financial institutions of the world. It's not just American institutions, it's institutions all over the world, European institutions, Chinese, whatever. And basically, financial institutions lend each other cash overnight, usually in the repo market, and they use U.S. Treasury securities as collateral. That's why it's a pawn shop. But in September, it looks like the whole financial system, credit system of the world was coming to its knees because these institutions lost faith and confidence in each other. And the repo rate, which usually matches the Fed funds rate, which at the time was around 2%, actually spiked to 10%. So the Fed had to come in and started actually bailing out the repo market. And then they started doing QE, which they called not QE. But of course, this year, we've had this crisis, and it's been a great excuse, of course, to do whatever it takes, not just by the Fed, but all the major world central banks. So that's the repo. And the other thing I wanted to show you that at the time, I thought it was strange, but looking back, it seems like these people knew there's something going on, that there was going to be something going on from around March time, right? And I always remember this article in the FT, and I talked about it probably in one of my videos, but I got the article here. It says, borrowing bump sets up UK as test case for bond market. Mild market reaction suggests investors are resilient to extra fiscal spending. This was from the beginning of last year. In the first week of 2020, the UK government borrowed massively, and everyone was shocked. So it says here, Boris Johnson's borrowing spree has started early. Officials in charge of managing the UK's bond issuance shook debt markets from their New Year slumber on Tuesday by announcing an extra 14 billion of gilt sales in the current fiscal year, which runs to the end of March. The scale of the increase, which bumps up gilt issuance for the full year to 136.8 billion, clearly took investors by surprise, generating a dip in UK government bond prices at the start of the day's trading. The only reason I'm showing you this is that I think there's a lot more to this crisis this year than just a health crisis. And this is a little clue, I think. At the time, I didn't know why they did it, but now I kind of think I know because they knew something huge was coming. And lo and behold, it did. I think this current fiscal year, which is the year after that one, because it starts in April, the UK government has borrowed I think it is on course to borrow 400 billion. I mean, it's just crazy. So they're testing the waters. Maybe they knew something, or maybe they didn't. Maybe it was coincidence, but who knows? So now that I've gone through all of this, through the repo market, we're going to go through why I think this crisis really has been brewing for a lot longer than just this year. It didn't happen this year. This year it was just the culmination of it. And it's just a series of crises as well since the fall of the Bretton Woods system, which was a monetary system based on sound money. It wasn't a classical gold standard, of course, but it was better than what we have now. It anchored the system. It didn't allow politicians and bankers to go crazy with their spending and lending. It didn't allow politicians, central bankers to manipulate things because it was very difficult because you had to have the gold to show for. And what would have prevented our fall into fiat currency? Well, it was very simple in 1971. And I think John Exter advised Paul Volcker, who worked for Nixon at the time as Undersecretary of the Treasury for International Affairs. John Exter told Paul Volcker, there's a few things you can do. You can raise interest rates so that the gold will stop flowing out of the US. Of course, they didn't do that because politicians don't like higher rates. He said you could revalue the price of gold, so devalue the paper dollar from $35 to wherever you thought would be appropriate, or you could close the gold window, default. So I think what we're seeing now is really a crisis where we're actually going to default for real because they prevented the default. They called it closing the gold window, and they kept going, and they were able to convince foreigners to use the US currency, mainly through the petrodollar. But yeah, I think it's over now. So let's go through the data that I think shows that it was more than just the crisis this year, right? The health crisis. So I'm going to start with the United States and then the UK. And then after that, I'm going to go in no particular order. I don't have a preference. The reason I started with the United States is most of my viewers are in the US. In the UK, I'm here. A lot of my viewers are here as well. But also because the United States is the biggest economy, has the reserve currency. So you can see this is from the IMF, and you can see the debt of the United States. This was in 2018, and you can see that it also started rising after the 2008 crisis. It's even more now, of course, it's at almost 130% of GDP. So this has been going on since '08, and also if you look closer, the debt started really building up in the early 80s in terms of GDP. So the more debt there is, the more crowding out there is. And just before I go further, there's also a paper written by Reinhardt and Rogoff about how increasing government debt to GDP slows down the economy. They wrote a paper about it. Do you really need a paper to show or explain that? Not really. It's just that more and more debt really slows down things. And don't forget, government borrowing crowds out the private sector. But it's only the private sector really that creates growth, wealth, and jobs. Government doesn't invest. Government spends and destroys wealth. So now we continue. We go to the deficit, because it's the deficit spending every year that adds up to the national debt. And I was lucky to get some data here for the US going back even prior to 1970s. And you can see that the US government was a lot less profligate in the 50s and 60s. Yes, they were starting to run deficits there already, but you can see that the trend has been down for more deficits. And the other thing as well, some people including me, say they haven't done anything to really fix things after the '08 crisis, and they didn't. The banks and Wall Street are still at it. If they weren't at it, playing their speculation game with trillions upon trillions of derivatives, we wouldn't have had that repo crisis, I would say, I would argue, back in 2019. Hedge funds as well, broker dealers, they're all at it. And even pension fund managers, they're at it too, because there's no yield anymore, because the central banks have been manipulating interest rates through QE, especially after '08. And we're going to go through that after I go through these numbers here for several countries. So you can see that, yeah, in the '08 crisis, deficit spending went through the roof, and then it started correcting back up, less deficit spending. But as you can see here, since President Trump came into office, and I'm not criticizing President Trump, I'm just telling you it's since then, the deficit had been going back down in terms of more, like the amount, which is a bad thing, of course. And yes, in 2019, the budget deficit was almost 5% of GDP, and I think U.S. Growth, as we're going to see here, was just over 2%. So if you actually take out the deficit spending, as we saw from the equation for GDP, the economy would have had negative growth. So was it really the greatest economy ever? I don't think so. And we'll see here, the next chart, how GDP really has not really picked up, has actually gone into a lower range, and that's got everything to do with growth and time of debt that Reinhardt and Rogoff talk about. As you can see, back in the 60s, GDP would go up as much as 4-6%. Yes, there were recessions, but the economy would pick up a lot more. But as you can see here, ever since the '08 crisis, GDP has kind of not been able to pick up at all. And that's why I think after this 2020 crisis, it could be a 2020, 2021 crisis, where we've gotten even more debt and deficit spending. I think GDP will never be able to go back up to the levels we saw after '08. It's going to get even worse. Why? Well, because of all the debt. So that's the United States. Now we're going to go through this a little quicker, because I've done the same for all the other countries, all these charts. So we'll go to the UK. The UK is the same thing, as you can see here, general government debt. This is from the IMF. This is in 2018, where the UK was. A lot worse now. And I would say for the UK, you could add about maybe 15% more to that debt to GDP number, because they've put a lot of the debt that the government holds for nationalized banks off this calculation. So it's worse than it looks, really. And then if you look at the UK, yes, back in the 60s, the UK was already deficit spending. That's why I guess it was the sick men of Europe in the 70s. On the right-hand side, you can see that, yes, the deficits have shrunk since the '08 crisis. But I remember very well George Osborne in 2010, who was the chancellor at the time, saying that they wanted to pay off, or not pay off, but balance the budget by 2015. But you can clearly see that they never did that. And right now, I think it's almost 25%, the deficit to GDP. And I haven't put these years' numbers there, because I wanted to show you what was happening before, and how things were not great at all, and how GDP was actually decelerating. So here's the GDP for the UK. Hasn't been able to get back that much above 2%. And you can see that even in the 60s and 70s, it was able to get to 4, 5, or even 6%. But as I've said, the debt drag, the crowding out, of the private sector by government. And that's where I think the Keynesians get it wrong. They think that they can keep increasing debt and the size of government and that it won't have any effect. They need to wake up. So let's go and look at France. Same thing. Look at the debt. Debt to GDP in France has gone up massively up until 2018. And it's even worse, of course, after the crisis. The deficits. And deficits, of course, here is from trading economics, just to give them the credit. And you can see that France actually was running pretty much a balanced budget in the 60s. It was only in the late 60s that it started deficit spending. I guess it had to follow the US. And here's the bar chart of the deficit spending. Yeah, not a year there of a surplus. Not surprisingly, the French GDP has been stuck here below 2% since 2008. This data here is from the World Bank, by the way, the GDP data. So I'm actually taking globalist institutions' data. Okay, Germany. Germany is kind of a different story. And in two ways. Recently, the Germans had started or had been running surpluses, budget surpluses, and that's why the debt had been going down, as you can see here. But unfortunately, this year, everything is like gone the other way. But I wanted to show you the deficits for Germany. And I'll explain the cars in a second. So why did Germany run such big deficits from the mid-90s to the mid-2000s or thereabouts? Well, that was because of German reunification. And some of you might remember East Germany was a very poor country, a communist country. I think it had about 16 million people. I'm not sure, but it was smaller than Germany or West Germany. West Germany was a powerhouse, economic powerhouse, but they had to subsidize East Germany. So they had to accept the East German mark at 1-to-1, and they had to subsidize the East German economy. And that's what that deficit spending was all about. It wasn't because Germany was profligate. It was that if they didn't do that and help East Germany catch up, which probably it hasn't even by now. I mean, maybe some of my German viewers can tell me, but that's why they had to do it, because, or else a lot of East Germans would have gone to live in West Germany, and I'm sure some of them did. But if Germany was going to reunify, they had to try to help out, level the playing field. And that's what that deficit spending was all about. And that's why Germany had been running a surplus, as you can see here, for the last few years. Yes, they had to run deficits during the 2008 crisis, and that's how they got the debt down, because they were running budget surpluses. So the car on top is a Trabant, which was the major East German car. So it gives you an example of how the East German economy was before reunification. And of course, the car below is a Porsche, which signifies how much more wealthy and advanced the West German economy was. So let's look at German GDP. Yes, it also has kind of got a limit now, around 2%. And that's mostly because of the debt that it had to assume after the 2008 crisis. But I would say that looking at the surpluses that Germany ran, even though the GDP growth is fairly low, around 2%, sometimes 4%, it's actually a good private sector growth, because the government there had been running a budget surplus. And if you remember from the GDP calculation, that's a good sign. That means that it's real private sector growth in Germany that we've had. But now that's all out the window, of course. So now to Italy. Italy is at the opposite end of Germany. Italy has really had no fiscal rectitude since the mid 60s, as you can see, the debt to GDP, and it was already at an all-time high in terms of GDP, debt to GDP by 2018, and it's even worse now, of course. I don't have longer term numbers for the deficit, but a lot of red ink. No wonder, the debt keeps growing in Italy. And that's why the Italian economy is in such bad shape, as you can see here. Even prior to the '08 crisis, GDP had a really tough time getting back or getting over 2% per annum. But when the debt wasn't as bad in the early 60s, early 70s, you still used to get a little bit of growth, as you can see here. So that was Italy. Now the Netherlands. The debt has been pretty stable. You can see in this chart that it actually dropped a lot after World War II, but it started picking up in the 70s in the Netherlands. Let's see the deficit or budget balance here. They were following Germany the last few years, as you can see here. They had some surplus, but now all that is out the window, of course. Let's look at the Dutch GDP. Yeah, it seems to be something that's happening to all the major Western or wealthier economies. GDP is just like becoming less and less productive, mainly because of the debt. Now to Japan, the home of what people call deflation. A lot of people say, oh, we're going to go Japan's way. But as you can see here as well, it's only been since the early 70s that the debt has started to increase. It's gotten a lot worse, of course, after this crisis. Let's look at the deficit spending. Yeah, look at how Japan is. They've been deficit spending a lot. There's only a couple of years there prior to the '08 crisis where they tried to rein in their deficit spending. But, I mean, is it any wonder that the Japanese economy is not picking up, the private sector? Because government is spending and spending and spending. And we'll go next to the GDP. So there you go. Japanese GDP hardly gets back to 2%. And that's not surprising. And as you can see here, in the 60s and even in the 80s was a lot higher because there wasn't the drag from government debt. So there you go, Keynesian Japan doesn't need more government spending or deficit spending, I would say. The problem is now that we're addicted to it as countries. Canada now, yeah, Canada. Also, you can see from '08, the debt has started to grow. It's a little bit more different than the other countries. It's kind of always had quite a high debt to GDP, it looks, Canada. You look at the deficit. Yes, it's strange from the mid-90s to the mid-2000s. Canada was actually running budget surplus, but it's been different since around the '08 crisis, and it's probably gotten a lot worse. Canadian GDP, same kind of pattern, even though, it has been growing a little more than 2%. So Canada is kind of a different story, but overall, the debt's still there, right? Now, China, People's Republic of China. So you can see the debt is growing a lot. It was around 50% of GDP, 2018. I'm sure it's gotten a lot worse now. We'll look at the deficit spending. Yeah, China does a lot of deficit spending, as you can see there. There's 1 year before the '08 crisis, they had a small surplus. So, and now let's look at Chinese GDP. And you might think, well, Chinese GDP has always been like 6-7%. But actually, it was better back in the day. And you can see that it's actually dropping. And I think at the end of 2019, Chinese GDP growth was the lowest in about 30 years. So even China is slowing down. And now to finish off, let's look at Australia. Australia as well, since the '08 crisis, as you can see here, the debt has been rising, debt to GDP. Australia seems to have been a pretty good country in terms of balancing its budget, all the way up to the '08 crisis. In the years since like the late '90s, it was running budget surpluses. So, but now, as you can see, it's been running a lot of red ink since the '08 crisis. And I'm sure it's gotten worse this year. Finish off here with the country's Australian GDP has been stronger than most countries, but it's also starting to tick lower, as you can see. So now to finish off, let's look at QE and how QE has helped central bankers around the world, especially in the US, Europe, and Japan, and even China, keep financial assets elevated. How does QE work? Well, the central bank just creates reserves. Reserves are what they call money in the central banking accounts and also in commercial banks' accounts. They're reserves. They only call it money when it goes to consumers or companies' accounts. Any account that's a commercial bank or a central bank is reserves, but it's money for all intents and purposes. So what the central banks do, they create these reserves. How do they create it? Well, they type it into the computer out of thin air. Isn't that great? And then they go into the secondary bond market and buy bonds. And that keeps interest rates low, and that puts a rocket up bond prices, a rocket up stock prices, and they use that to say, "Oh, look, everything is great. Don't look at the debt. Just look at the bond market interest rates. There's no inflation. Stock prices are doing really well, right?" So here we go. And this has been really happening since the '08 crisis in spades, as you can see here. Total assets of major central banks, yeah, this is updated actually for the current crisis. You can see how it's just spiked. The second one is total assets of major central banks. And this is the percentage increase annually. And you can see that in 2018, the Fed was trying to normalize the situation by unwinding its balance sheet, by selling all the bonds to normalize their balance sheet. But that's when the stock market was almost imploding, so they had to stop that. And then the last picture here just goes to show you how the S&P 500 has really tracked the major assets of central banks. Well, they matched QE. Some people say that QE hasn't helped the stock market. Well, I think you can pretty much say that that's a fallacy, because you can see that the growth in central bank assets or the growth in QE has helped the stock market. And especially here in March of this year, of course, when the stock market was collapsing, they had to come out and throw the kitchen sink at it. And they're still throwing the kitchen sink at it. They're going to have to get another kitchen soon. So there you go. Yes, we are told, of course, by our governments, by the mainstream media, not only the overall media, but also the financial media, people like CNBC, Fox Business, Bloomberg. We're told that this is all happening because of what's going on this year with the health crisis, but they're not really looking back and seeing why this is happening, which is, of course, too much government, deficit spending, debt, too much leverage in the financial system, the repo market, right? And why don't they look at that? Well, because they want to keep the game going, and a lot of the mainstream press, or most of it, especially the business ones like Bloomberg, CNBC, Fox News, or Fox Business, They are financed by the people that benefit from this system. So hopefully this presentation or video helps you convince your friends that this crisis didn't just start this year, that it's been brewing for like over 50 years. And I would say this is probably an existential crisis for the system, and they're going to throw everything at it. But I think the big crisis, the way it ends, is that all currencies collapse, all the fiat currencies collapse, including the dollar, of course. So there you go. If you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Twitter, Parler, and all these other platforms below here. I wish you all a great new year now after Christmas. And hopefully you had a nice Christmas too. Take care. Bye.